Welcome to this summary of Common Stocks and Uncommon Profits, a book by Philip Fisher, who is one of the original fathers of investment theory and the founder of the renowned money management company, Fisher and Company. His book, Common Stocks and Uncommon Profits, originally published in 1956, has remained in print ever since. Discover the timeless principles of successful investing, whether you prefer high-risk or conservative strategies. Despite fluctuations in the stock market, the fundamentals of investment theory have remained consistent over generations. Even though Common Stocks and Uncommon Profits was published in 1956, its investment advice remains as relevant today as it was during Eisenhower's presidency. These insights outline essential characteristics to consider when investing in a company, helping you determine your risk tolerance as either a high-risk or conservative investor. Similar to a detective, a savvy investor conducts thorough research to gather pertinent information before making investment decisions. Upon watching this summary, you'll learn how to assess if a company's stock is overvalued, understand why stock price alone doesn't indicate a company's quality, overcome doubts and make confident investment decisions without hesitation. Before we delve into the key highlights from this book, please consider subscribing to our channel and like the video. Now let us continue. Part 1. Smart investment strategies focus on companies with long-term growth potential. Contrary to common perception, successful investing isn't about fast-paced trading for quick profits, but rather strategic planning focused on long-term growth. Smart investors seek companies with potential for sustained growth, aiming to multiply their initial investments over time. Identifying such growth opportunities isn't easy, as many stocks are either overvalued or undervalued. Smart investors target undervalued companies with growth potential, anticipating rapid growth that can significantly increase their investment. Companies with growth potential typically share common characteristics. They offer products and services capable of sustaining high sales volumes for extended periods. Moreover, they invest in research and development to fuel continued growth, even when current product lines plateau. For instance, in the 1950s, television manufacturers faced stagnant growth until the development of color television. Companies like Motorola pivoted their business strategies, leveraging technical expertise to enter new markets such as two-way communication, sustaining growth while competitors struggled. Additionally, companies with high growth potential boast solid management teams and positive employee relations. Avoid investing in companies plagued by internal conflicts or uninspiring leadership, as these factors can hinder productivity and growth. Part 2. Do your homework. Research a potential company from every angle you can before you invest. Successful investing shares similarities with detective work, requiring thorough research and analysis of available data. To assess a company's investment potential, comprehensive information collection from various sources is essential. While seeking recommendations from traders is an option, their interests may not align with yours, leading to potentially biased information. Instead, employ the scuttlebutt method, gathering information from diverse sources such as vendors, customers, former employees, and industry experts. Contacting competitors can also provide valuable insights. Once a comprehensive profile of the company is developed, directly engaging with company management to ask informed questions is crucial. While effective, the scuttlebutt method is time-consuming. To maximize efficiency, carefully select companies with growth potential for research. Seek recommendations from friends, investors, or printed materials, and avoid companies with red flags such as managerial controversies reported in the media. By meticulously gathering and analyzing information, investors can make informed decisions and maximize their chances of success. Part 3. Look for dips in a stock's price to get in cheaply, to ride high when the company grows. Identifying a company with promising long-term growth potential is just the first step. Knowing when to buy is equally crucial. However, the stock market's tendency to overvalue or undervalue stocks complicates this decision-making process. Stock prices reflect the current perception of a stock's value within the financial community, often leading to price bubbles when stocks are overvalued. Conversely, unexpected setbacks or expenses can cause stocks to be undervalued, even for companies with strong growth prospects. Understanding this irrationality can lead to extraordinary profits. Innovating companies inevitably encounter obstacles, causing the financial community to undervalue their stocks. This presents buying opportunities for savvy investors. For instance, imagine discovering a widget manufacturing company with significant growth potential. Initially, hype drives up the stock price, but when issues arise, such as improperly sized casting molds, the stock price plummets as investors lose confidence in the product's success. This creates an opportunity to buy stocks cheaply, as you anticipate the company resolving its problems and rebounding. Even if you miss the initial opportunity, subsequent dips in the stock price can provide further chances to invest at a lower cost. By recognizing the market's irrationality and seizing opportunities during downturns, investors can capitalize on the long-term growth potential of innovative companies. Part 4. Be confident in your choices. Don't give in to doubt or follow the investor herd mentality. Doubt is natural, but successful investors must overcome hesitation when they identify a promising stock. The tendency to doubt often stems from the influence of the crowd. However, as seen, the financial community frequently misjudges a stock's value. Therefore, buying when others are selling can be a wise move, as it prevents overpaying for a stock. Resisting the urge to wait for a better deal is crucial, as opportunities may not repeat themselves. One example illustrates how hesitation can lead to missed opportunities, with a small difference in share price resulting in significant losses over time. Once a good investment is found, holding onto it is advisable. Selling should only occur if the company's growth potential is misjudged, its conditions change, or it serves as a placeholder while searching for a superior investment. Avoid selling prematurely for quick profits or following the crowd, as a company with substantial growth potential can never be overvalued. Part 5. Conservative investors should seek out solid, organized companies with growth potential. For conservative investors seeking gradual but consistent growth, investing in strong, established companies with growth potential is paramount. Startups, despite their promise, are generally too risky for this strategy. Instead, focus on large, prudent companies with a track record of profitability. However, it's essential for these companies to maintain their market position by continuing to grow. This growth doesn't need to be astronomical. It simply needs to be sustainable to fend off competition. Such companies typically possess 4 key characteristics. 1. Cost-effective production methods enable them to remain profitable even during inflationary periods or market downturns. 2. They are well organized and efficient in delivering products and services to the market. 3. They boast a strong track record in research and technical development, allowing for ongoing innovation and improvement. 4. They demonstrate financial savvy, allocating resources wisely to initiatives with profit potential and recognizing warning signs indicating the need for strategic shifts. Part 6. Valued employees form the core of any stable, growth-oriented company and are good investments. For conservative investors, assessing a company's treatment of its employees is crucial, as it offers insights into the company's operational effectiveness and long-term potential. There are 2 primary reasons for this strategy. Firstly, a company's growth potential relies heavily on its employees who execute its strategies. Employees drive innovation, implement cost-effective production methods, and contribute to the company's overall success. Therefore, examining the quality and dedication of the workforce is essential to understanding a company's ability to sustain growth. Secondly, the treatment of employees reflects the company's overall effectiveness and productivity. A company that values its staff tends to foster a positive work environment, leading to increased productivity and efficiency. Conversely, mistreated employees are unlikely to deliver optimal results, hindering the company's performance. Observing human resource and management policies provides valuable insights into a company's operations. For instance, a reluctance to promote from within may indicate a lack of investment in employee development and training, signaling poor management of human resources. Similarly, examining managerial dynamics can reveal how effectively the company is run. A manager who operates independently rather than fostering teamwork suggests inefficiency and poor leadership, which could impede the company's growth. In summary, conservative investors should prioritize companies that demonstrate a commitment to employee well-being, effective management practices, and teamwork, as these factors are indicative of a company's long-term potential and stability. Part 7. A conservative investor looks for companies that can ensure profitability over the long term. When assessing a company, conservative investors must consider not only its current strength, but also its ability to maintain its position in the future. Profitability is a key indicator of a company's long-term viability, with profit margins being particularly significant. Higher profit margins indicate stronger potential for sustained growth, especially during economic downturns. Long-term profitability is essential for financing future investments in research and development, inventory expansion, and marketing efforts. Additionally, profitability provides a financial cushion during challenging times, ensuring the company's survival when costs escalate. To ensure long-term profitability, a company must outperform its competitors. Market dominance can be achieved through scale advantages, where larger companies benefit from lower production costs per unit compared to smaller competitors. Additionally, creating proprietary technology protected by patents or copyrights can secure a company's market position by preventing competitors from replicating its innovations. Investors should assess whether a company's strategy accounts for and prepares for its long-term business development, ensuring sustainable growth and market leadership. Part 8. Calculate a company's price-earnings ratio to determine whether you're paying the real price. The valuation of a company's stock can be highly subjective and influenced by the preferences of individual investors. What may be considered valuable to a risky investor might not hold the same appeal for a conservative one. For a conservative investor, the focus lies on investing in stable, growing companies that are either undervalued or priced at their true worth. This involves assessing the company's price-earnings ratio, calculated by dividing the stock price by the earnings per share. For instance, if a company earns $1 per share and its shares are priced at $10, the price-earnings ratio is 10 by 1, or 10. However, if the company reports earnings of $1.82 per share in its annual report, the ratio would decrease to 10 by 1.82, or 5. While higher earnings can lead to a spike in the stock price, conservative investors must evaluate whether the company's characteristics justify the market's optimism regarding future growth. This is crucial as the perceived value of the stock may exceed what the conservative investor deems reasonable. While investors seeking short-term gains may not be deterred by a $40 share price, a conservative investor might consider it too steep, especially if it exceeds their assessment of the company's true worth and management capabilities. To succeed as an investor, thorough research is essential. A company's true value extends beyond its stock price, requiring diligent investigation. Whether you're a conservative or high-risk investor, the rewards are substantial for those willing to put in the effort. Actionable tip: utilize your bank as a valuable information source. If you encounter difficulty accessing information on a company, reach out to your bank for assistance. By openly expressing your intentions and ensuring confidentiality, they can facilitate introductions and provide valuable insights to aid in your investment decisions. And lastly, thank you for watching this video, and please like the video if you enjoyed it. Also, let us know what you rate this book in the comment section down below and what book we should review next.